Welcome back, guys, to another Zero DTE podcast. We're on Season 2, Episode 27, where Ernie answers the question, is bigger better within the trading world? If you're interested in becoming a pro trader, check out the link in the description to Ernie's course. And as always, I hope you enjoy, guys.
All right. So I had another failure. Failure is the name of the game. But with failure, you have to know how to bounce right off of it and get right back into the saddle. So the failure this time was that I again lost my notes. I'm using ChatGPT, and it has a very odd way of organizing all of your previous sessions. And there's no way to order it or really filter it or do anything like that. And it doesn't give you a chance to rename the identifier in this list of sessions that you have. Yeah, I created this wonderful show with notes and outline and all this other stuff, and it's lost somewhere in the hundreds of sessions that I've had with ChatGPT. So anyways, let me just, again, do this directly from the top of my head and exactly what I wanted to talk about, which shouldn't be too hard because I live and breathe this stuff. So the big question with trading Zero DTE, and of course somebody is obviously calling me right now. Never ceases to fail. I'll just have to put this on quiet. The next thing is I'm waiting for the wife to come down and ask me a question or something. So here's the thing. The title of this episode is bigger better when trading Zero DTE? Now, what do I actually mean by that? Now, first of all, let me explain the overall strategy and what we do. We're trading the Zero DTE event on options on the S&P derivatives. So we'll trade options on the SPX, the NASDAQ, the E-mini S&P futures, and also the mini SPX, which is called the XSP. And also I'll add in there the NASDAQ index, the NDX. So we have all four of those things that we trade options on the Zero DTE event. Now, our strategy involves two primary overall strategies or methods. And that is that we want to collect premium on the last day of expiration, because that's where premium is going to decay at its quickest rate until it goes to zero in the smallest time window possible. And we trade asymmetric risk to reward. In other words, we take very tiny risk and we're looking for outsized rewards, typically or as a minimum of 1 part risk to 9 parts reward. And quite often we'll trade 1 part risk to, say, 12 or 15 or 20 parts reward, 1 to 20 trade. Now, I know that most people trade options. They're putting on iron condors generally for a Zero DT event, and they trade something very different where they'll take 10 times the risk for 1 part reward. So in other words, they'll put up $1,000 to make $100. And they're not just going after that 100, they're going after only half of that 100. So it's really a 20 to 1 risk to reward, where we are potentially a 1 to 20 risk to reward. You can see there that it is clearly 2 or 3 magnitudes of greater efficiency the way we trade. So anyways, that's the overall strategy, and that's how we trade. And the way we achieve these these trades is by putting on out of the money butterflies. And so what that really means is that we're treating the butterfly as a directional instrument in some cases. In other cases, we look at the market from an agnostic position, and we put a butterfly on one side, on the plus side or the bullish side, and a butterfly on the bearish side. So those are the two primary ways we do it: market agnostic and then trending. So there you go. There's the universe of what we do on how we attack Zero DTE. Now, here's the question. Now, when I first started this service a little over 2 years ago, the question was, how far out of the money do we put it, and how wide do we make the butterfly? Now, we use the butterfly because it allows us to create that risk to reward. And at the very outset of this strategy and the exploration of what worked and what didn't, I would make the proclamation that we can put on these, but we never want to have a risk to reward that's less than 1 to 5. Now, sometimes I put on a 1 to 3, 1 to 2, 1 to 7, 1 to 15, whatever. And I did that for almost 2 years. And I came up with all kinds of results, all of them positive. And then after reviewing and analyzing all the results, I wanted to see where I was getting my greatest return and what was the most significant. Where should I be putting most of my effort? Should it be putting it in at a certain risk to reward or a certain width or some combination of the two? What worked the best? Now, also the other intricacy or nuance to this is, which way do we go? Do we trade a single fly or do we trade the double fly, which I call the Batman? Because when you look at the at expiration, the 2 flies, it looks like Batman's ears. That's the trade that we're going to be putting on most often. And that's the reason for that, is that we really, most of the time, have no idea which way the market's going. We shouldn't pretend. There are some cases like in the 2020 market or 2021 where the market just went straight up and it just made a lot more sense to go with the trend and trade the singular fly. Okay, so there's all of the context that you need to know. So okay, where can I find a track record for your method? All right, it's on the website. You can't miss it. It says trade log. There's some other questions. That was Casey Dunn. And then Nicolay says, oh, by the way, I haven't updated the log in the past month only because the growth of the service has been unbelievable. I've had an explosion of new people. I had to hire 2 new people. I've also been involved in development of a number of things. So just to let you know, I will be updating the last month's returns. But the trade log that's up there represents about 250 trades or so. All right. And all of those trades were taken inside of the service. So instead of giving alarms via SMS or Discord, do you provide a course on your strategy? I don't give any alarms or SMS. There are no alerts in this service at all. In fact, the service itself is a coaching and mentoring service to help people become professional traders. That's pure and simple. When you join our service, it would be not much different than if you had joined a prop trading firm and they were training you and cultivating you to trade on their trading desk. I have specifically that kind of experience, and that's what I'm bringing to this service. You come into this service fresh, whether you're a pro or a beginner, and you will be trained to become a professional trader. All right, let's see. There's another case. Rob saying, Casey Dunn, there is a manual and video series inside the membership section of the website. Yep, there's that as well. So yeah, if you want to join, you can get all that stuff. Oh, I see. That was meant for Nicolay. All right. And let me sign up. The sign up is down below. You go to 0-dte.com/try, and you can take the 4-week trial, find out what the service is all about, and then you're there. Okay. Now, getting back, I want to make sure that I answer all of the questions. It's very important to me. I spend a huge amount of my time directly involved with every part of the service. I am completely transparent and open and available to every single member. And that's a lot of members, 1,500 or so right now. At any one time inside of the trade room, we have about 300 or so that are active. All right. This is a highly involved service. You're going to be getting group coaching and mentoring. There are a number of people inside of the service. The trade room is beyond anything that you've ever seen. I have really cultivated the culture within that trade room. There are newbies as well as pros, people that have very experienced with the strategy and the process. They're all there, very supportive. It's fantastic. I've been told by many of the pro traders that are in there that they've never seen a trade room as good as the one that's inside of 0-dte.coms. All right. Get all that out of the way. Now, back to this idea, is bigger better? So what I found was we started at first smaller and then grew. And after the course of maybe 200 or 300 trades, I did an analysis and I started to find out that, and I was kind of constrained because I was trading at first with a smaller account. Then I moved to a mid-size account, and then I started trading in a bigger account. And so naturally, I was keeping my risk in check, and so I was trading smaller flies. and lesser risk. And then as I moved up the chain, I started realizing how far I could go, or maybe I don't realize just how far I can go yet. And in doing the analysis, I found that, at least at first, my average risk to reward that I was taking in the first year was a 1-to-7 risk to reward, and the average width of the fly was about 20 wide. And that's 20 wide per side, so total 40 wide. And I thought, that's cool. So I made that as my kind of my minimum from that point on, from that first year on. And in the second year, I did a similar analysis, and I realized that, man, I seem to be approaching a 1-to-9. And then after looking at that, a 1-to-9, and not 20 wide, but 30 wide. Now, I had taken a wide variety of trades. I had tried 1-to-10, 1-to-15, 1-to-20 even, and every kind of trade. Now, most of them were converging to that 1-to-9. It's actually, if you look at my trade log on the website, you'll see that the average is a little bit over 9. It's 9.2 or 9.4. All right, so now I've moved up the sort of minimum starting position at 1-to-9. Now, it's interesting that the 1-to-9, the way you would take that trade, the way you would put an out-of-the-money butterfly on with that would achieve a 1-to-9 risk to reward, is you use the 10% rule. And this is a rule that I've seen used with professional traders on trading floors and the pits and so forth that are trading options, that were trading butterflies. They called it the 10% rule. And basically the way they put the trade on is that they would look at the width, and then whatever the width was, they made sure that the debit for the fly was 10% of the width. So in other words, if you put on a 20 wide fly, then it would be $2. If it was 25 wide, then it would be $2.50. If it was a 30 wide fly, it would be $3. You get the point. And so I said, okay, that's a really good way to adopt what is already being a standard bearer for professional traders that are trading the butterfly, out of the money butterflies. I don't know if you knew that, but most professional traders employ the same principles that we do, and that is asymmetric risk to reward and premium collection. That is a stalwart in the pro trading circuit. Completely absent, I would say, with retail traders. But that's the whole point. In this service, we're teaching pro methods, pro process, pro strategies. So anyways, we're now standardizing on a minimum of a 1-to-9 risk to reward, and then as wide as you can make that fly. Now, some people, depending on the size of their account, they might not be able to afford a 30 wide SPX, which would be a $300 debit for that. And it might not fit into their risk to reward scenario. You could trade the E-mini S&P, which is about half the size. So that 3 wide would actually be $1.50 or $150 for a 30 wide, because the E-mini S&P, its multiplier is half that of the SPX. You could go the XSP, which is 1/10 the size of the SPX. So that would mean if you're putting on what would be the same equivalent width as a 30 wide, would actually be 3 wide. And so then it could cost you just $3 or 30 cents for that. So that would be an equivalent, 30 cents off of 3 wide. That would also be 1/10 of the width. And when you do the math, you know that the max profit of a butterfly is the width minus the debit. So you take that, say 30 wide, minus the debit of $3, so that would leave 27. So 27 would be the maximum profit that you could make on that. Then what you do is you take the debit and divide it into 27, and it goes into it 9 times. So that's how you get, when you put on a 10% debit of the width, automatically turns into a 1-to-9 risk to reward. So it's kind of like the magic number that's been traded for many, many years. And it is what we ultimately grew to, and it seemed to be the optimal trade. But it got me thinking. I started at 1-to-5, moved to 1-to-7. Now I've gone to 1-to-9, which I probably should have started at from the beginning, but it was a learning process. And then when we put on the Batman, we were wondering, how do we handle that? Do we make them both 1-to-9? Now our risk is a bit bigger in the middle, and how do we handle the risk management there? Or do we spread them out and make them wider and just go for broke? And so what we're finding, here's the interesting part. It seems that I don't know what the upper limit is. In fact, some of my best